Well, this is the Board of Trustees presentation, and here we go. So this is just the company overview. We're gonna just go through a couple of the things here. The net revenues, as you can see at the chart, we have positive values going up all the way from year 5 to year 15. And there was a slight hiccup with action camera sales between year 8 and 9, but we're generally happy with the positive flow we saw. With our image rating, you can clearly see we had an all-time high at year 6, and at year 7, otherwise known as the dark ages for our company, was the all-time low. And from our all-time low, we started a gradual increase, increasing from year 9 to 10 a little bit more dramatically. But after we settled into that little score, we found out that that's kind of the comfort zone for us. With our credit rating, you can see just like prior, year 6 was catastrophic and year 7 wasn't that good either. But we saw improvement, and drastic at that, from year 7 to 8. And after that, we just really kept going up. And even now at year 14 to 15, we're at almost off the charts all-time high. So we're very happy with our credit rating. Now on towards their stock price. We see that, I guess, everyone had the same type of flow with the beginning, where our stock prices were at a pretty low state. But as we see at year 9, we jumped dramatically, and we just kept going up really from that point on. From year 13 to 14, we saw our stock price drop just because we issued some stocks, and that makes sense. But after that, we climbed right back up, and we're at a state again where we're pretty happy. With our earnings per share, just like the other graphs, year 6 all-time low, and year 15 is an all-time high. And we can see the steady growth from years 10 to 13. We're happy with that. And our return to equity, year 6, all-time low. Year 6 was by far the worst year for us. We can clearly see with the data. But we can also see from year 6 to 7, we did something that caused our entire company to shift in all values positively, and we have an all-time high. And so after that, we see a pretty steady rate all the way, closing out the year at year 15.
So here at GStone, our strategic vision is founded under one simple undercut idea, which will result in competitors' prices in the overall market while maintaining an above average position with regards to our product quality. Our main goal is to provide customers with a quality, competitive product. I gotta move my camera. The slide changed.
Sorry.
Thank you. Competitive products at a lower cost than the other leading competitors. With this, we will do this by valuing flexibility and the ability to see the consumers as one and as someone who wants the best product for the cost. We also will maximize our return on equity and our EPS to make sure that our investors are interested and happy while monitoring our stocks and buying and selling accordingly to the data. Our motto is, there's nothing better than overspending except buying our products. We can go to the next one.
So for our performance targets, when it came to our future performance, we really are only interested in the growth. And as you can see, we have gone through the ups and downs of the business world, and we've seen what happens when you don't do well. So we just want to aim for the good parts of the business formula and for our financials.
Go ahead.
For our EPS, we are aiming for an increase to 13 to 13.50 for the next 2 years.
And for our return on equity, we want at least a 4.2% and 45% respectively over the next 2 years.
And our credit rating and image rating have kind of stayed the same for a decent amount of time in the simulation. And so we kind of figure they're going to continue down the same path. However, we're hoping that our image rating would probably go up from 75 to 78 respectively in the next 2 years. And our credit rating, we're hoping, would stay at an A+ rate, which would be awesome. And when it comes down to our stock price definitely varied a little bit, but we saw positive views in it. So we're hoping that we could get it up to $330 next year and even $345 the following.
It's loading. I have really bad Wi-Fi. There it goes. For the AC camera and UAV drones, we had, so as you can see in the beginning, around year 6, we kind of switched the strategy up a little bit, and I'll get into that here. In the beginning of the semester, when we first started out the Glo-Bus simulation, we had some troubles with the action capture cameras and UAV drones. Our thought process was that we can gain advantage over all the other competitors if our product was the cheapest. However, we found out that it was not the case within the first 2-3 years, especially year 6. We found ourselves being the worst company because of our decisions, all because we were making a low quality product for a low price. At the end of the day, we found out that it doesn't matter how cheap it is. We just need to find the balance that meets somewhere in the middle of a good quality product that people want to acquire for as cheap as we can make it. So we started out making a very cheap product all the way around. And as a buyer, you're not just looking for the cheapest, which means the quality of it's also the cheapest. So around year 6 to 7, we went ahead and made a change to go ahead and up the quality a little bit, which did up the cost of making it and the production of it all and everything. The cost did go up with it, but as you can see, it was a good decision. We started to tweak some of the numbers and the quality of cameras and materials that was going into our products. In the beginning, all the cameras were at the lowest setting that could have been on, along with the material and the process assembling the camera and the drone. Once we found this balance, we didn't see a turnaround right away, but we did within a year and started to make up the ground we lost. By the end of the simulation, we were able to climb back to the mid-range competition and feel as if that was an impressive turnaround. From here on out, looking to the near future, we're going to continue to find that balance between a good quality product and that people want to acquire for a good price. I believe that we're on the right track to continue gaining some of the ground within this competition for all the other competitors.
For our production strategy, admittedly, this was one of our worst columns in the simulation. We really didn't put our effort into it. We kind of underpaid, and by kind of I mean severely underpaid, our AC camera workers. And due to that, I believe that did adjust or affect some of our pricings and overall expenditures. We also didn't really have an overall good worker compensation for that side of the facility. And oddly enough, on the other side with the UAV drones, we had a disproportionate amount of benefits and incentives for them. We increased the workspace for the action camera facilities, but we didn't really do much else for them in terms of expansion and helping them out. We wanted to upgrade for robotics and all the ACC workstations, but we looked at our budget and we found that it wasn't really going to work with it, so we decided to opt out of it. And with our financial strategy, this was also a bunch of craziness. It turned out to be a saving grace, but it was really an awful ball and chain towards the end. We used a variety of different methods, including, like taking out loans and selling stocks, trying to take us out of the depths of our financial crisis. But in the end, we took out loans and we ended up with a good credit rating, but we didn't have really money to financially keep us stable and supported. We ended up doing a lot of experimenting with our finances, and we decided that with our dividends, we kind of wanted to stick to a dividend policy of $4 as a minimum. And after that, we kind of wanted to increase it according to what our EPS would allow. So in year 14, we even had so much as a $11 dividend. Of course, we had to drop that because financially we couldn't support it. But we would like to, if we could, increase it back up, maybe even upwards of $12 and $13 if the financials allow it. With our competitors, we've been up and down the scoreboard so much that we had several competitors at some points. At one point, we were even looking at the top 3 as what can we do to get past them. But after the dust settled and we kind of found our spot, we realized that Group J and Group E were really the people we could focus on because they were our immediate up and down. With Group E, they definitely had some shakeups and they've seen some up and downs too. And you can even tell at the end of year 15, they're trying to undercut our AC camera prices, but they ultimately are beneath us to the point where we kind of have working room in terms of competition there. Our real competition for us really is Group J because they barely beat us with the overall score. And they have models that aren't really following what our business model is. They have stuff that's more expensive and higher PQ ratings. And we believe that this difference is what's kind of making them above and beyond just us, just a little bit. So how are we going to take them out? I'm sure that's what you're asking. When it comes to AC cameras, if we had more time in the simulation, we'd love to gain a greater advantage just over the bottom groups like Group E in the AC camera department. With the prices that we have, we can tweak them a little bit further and make it so that the cameras have a higher incentive value in actually buying, which is going to increase the market share and take customers away from an already struggling company in early monitoring sunrise. And when we shift over to the UAV segment, this is where things are a little bit more complicated and tight because both Group E and J are actually doing a little bit better when it comes to overall sales. They have a higher PQ rating and they have a higher profit or price point, which even though we're getting higher revenues over time, we kind of think that we can put them out of sales that they can potentially gain. With a PQ rating of a 6.9 with Group J and a 6.1 with Group E, we have some ground to cover because ours is only 5.3. But we believe that we can increase our PQ rating up to like a 5.8 at 6.2. We can really show these other companies that we mean business and actually take sales away from them. Now, our camera models are kind of in a good position, so we don't believe we need to really adjust things there. So our first form of attack would be to attack UAV sales.
So to craft the winning strategy, we were able to create a quality product that people are interested in buying, narrow down our exact wants and needs regarding our market division and a step-by-step plan, find different avenues to take out the unwanted extra costs from the resources that we were using, and determine the best option to pursue a goal of market share dominance within a respectable margin with a high EPS. The do's and don'ts to be competitively successful. So the first do is to address the laziness so that the managers can carry their fair share of work. The next one is to pay attention to details to maintain product relevance, be knowledgeable of the business management do's and don'ts, constantly work to improve our products and designs, plan accordingly so that our managers stay on task, value creation and original ideas so that we create a unique product and have effective customer service that our customers are happy. The don'ts to this are to not lack advertisement and underestimate the power of social media and word of mouth referrals. We live in the technology age and era so that many ads and things are more so, online rather than in newspapers and stuff like that. We also don't want to use cheap equipments and parts that will result in our products having a short life. So that's pretty much what we were doing in the beginning. We were doing more quantity than quality, which backfired on us in the long run. And then we also don't want to ignore the trends that will have our products behind compared to new innovations or steal ideas or copy the rivals' work. The do's and don'ts to be financially successful. For this, we want to monitor the progress of the rival companies so that we can stay up to date with the overall demands. Distribute costs to help the company move in a profiting direction that will benefit the success of our business. focus sales and service efforts on delivering satisfying customer experiences in the industry, and have funds to implement effective marketing and achieve long-term business success. The don'ts for this are to not take out loans for an amount that our company cannot repay, and forever be in debt. Ignore the debt to assets ratio and times to interest earned ratio. Build up a credit reputation with frugal purchasing, and just like I said before, cheaply buying stuff to create our cameras and our drones, and partake in fraudulent illegal activities.
We learned several things during the simulation, from the time management skills to understanding the coincidences of the financial decisions made while running the business. However, all of us at GStone believe the greatest lesson we've learned is something we call lazy management.
During the weeks 3 to 5, we thought that we could lower the prices of the resources needed to make our product. We thought that by increasing and decreasing the qualities in multiple areas, it would lead to us having an advantage over other competitors, and in result, it did not work.
So to the Board of Trustees who are watching this video right now, we apologize. But more importantly, to our teacher, Mr. Hensley, who organized the simulation, we apologize even more. We took the simulation for granted in the beginning, and we honestly missed the point of it. However, as you could see, we did kind of correct ourselves, and we think by the end, we finally saw how much fun it is to see financial growth and progression. So with that, we thank you, and that's the end of our presentation.